tough to anticipate what's going to happen with interest rates. It's tough to anticipate what's going to happen geopolitically. But if you have access to capital and have your strategy in place, you can be nimble and pounce at the right time to make a deal when the right factors line up.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In this week's episode, I'm joined by Jonathan Keith, Managing Director at Deloitte Touche. Jonathan is with me to review the landscape for commercial real estate M&A activity and what that might look in terms of potential investor opportunity as we look forward. Jonathan, thanks for joining the podcast today.
Great to be on.
So, to set the stage, can you walk through how commercial real estate deal activity transpired over the course of 2025?
To be candid, it was not a great year in both deal volume, and I'm talking globally, both deal volume and the number of deals dropped somewhat significantly. I think global commercial real estate M&A value declined 57% year on year. Deal count fell even more, over 70%. Doing that math, the average deal size increased a little bit, and deals in the United States averaged about $300 million. But overall, it was a disappointing year or a slower year from a real estate perspective.
So bring us up to speed on where things look today and really what areas you might see the most activity.
So I think there is continued to be some caution. Obviously, there's some geopolitical factors, the events in Iran, the impact of inflation, the impact of interest rates are all causing some caution in the market. I'd say in terms of where we would expect activities, when you think about real estate, it's very sector specific. And so we're seeing a lot of hot sectors, data centers, to some extent, multifamily, industrial, some residential, and an office is a mixed bag, if you will, in certain narrow situations where we probably see some more activity in 2026.
And focusing a little bit on data centers, what role do you see them playing in commercial real estate M&A activity in 2026? And given the issues like power constraints and local pushback, how might those deal structures evolve?
Great question. Data centers are very hot, for no pun intended, right? But they are a major area of focus for M&A. Obviously, the underlying need for AI, cloud demand are driving enormous pull of capital into that area. So it's very attractive from a demand perspective. On the flip side, on the supply side, you have a lot of large public platforms already been taken private or recapitalized. So there's intense competition, right? You have strong demand, limited supply. So obviously prices will go up. Your question about power is an interesting one. I think if you go years back and people thought about data centers, it was important to get a good property, build it up, make sure you have good construction, and the focus was on leasing it up. Now the first question is, do you have power? Can you plug it in and get rolling? And to your question, there's community pushback or opposition around that drain on the power or not wanting to allocate the resources within a community to support that. So I think going forward, the fact that there's some power scarcity, there's community opposition, I think folks could hedge their bets a little bit and use more JVs, preferred equity, maybe utility-linked partnerships to kind of spread the risk around, and the risk around power, but also development certainty.
And in terms of geographic markets, Northern Virginia is obviously a very active market. Any other areas of the country where you expect to see things happening?
I think Virginia is a large hub. Silicon Valley is a large hub. The Austin area is a large spot. And you're seeing some other pockets grow up. There are some places where regulations are a little bit more loose and they're opening to, I believe Nebraska is one of them, where they're giving sort of tax incentives to build out there. And then you see other geographies. For example, Maine has been in the news about saying we're going to put a halt in data center construction, I should say, until we get our arms around what that really means. The local jurisdictions and the local communities' views towards it will have an impact.
And let's turn now to the office sector. What sort of opportunities are you seeing there? And are particular assets really drawing in investors at this point?
Yes. So office has been a struggle over time, right? That's the whole story. Going from COVID to then a limited back to work has put pressure on the office story. I think what we're seeing currently in the market is like Class A buildings in large cities are heating up and getting a lot of attention, if you will. What you're seeing on the flip side is probably that lower level Class B, if you will, it's less attractive. So, for example, where I'm in Manhattan, the overall lease space availability for the first quarter was somewhere around 15%, which is probably the lowest level it's been. And again, the lower that level, the better, right? So the availability is talking what inventory is out there since 2020. And so it's really a more vibrant market. The overall U.S. office market is not as good shape. I think the overall national vacancy rate, looking from, I guess, the first quarter of 2026 is up maybe almost a percentage point from 22 to pushing 23%. So it continues to be a challenge there.
And do you expect residential M&A activity in 2026 to become more geography-driven?
So I think, again, much like I was talking about in the office, where region matters as well in the residential side. So you have in the Sun Belt, when I was talking about maybe broadly Sun Belt, when you think about like Florida, Texas, Arizona, they've had a bit of a reset. They have a significant amount of inventory, and some of that was built to meet pandemic migration. And I think that's slowed a little bit. The combination of that slowing, interest rates going up and making it more difficult to purchase home has tilted more supply and less demand in those regions, which have cooled the market. I think then in contrast, like the Northeast and the Rust Belt, so if you think about like the Midwest, the Northeast, much more competitive, tighter constrained supply, right? Just in terms of geography, there's not as many places to build houses, if you will. That with the overall interest rates have squeezed buyers and made it difficult. I would say there's an issue with interest rates in general with a new buyer going out and trying to secure a mortgage. But I think one of the stats I saw was about 72% of existing homeowners still hold a mortgage below 6%. So it's one thing if I'm the outside buyer coming in and saying interest rates are very high, I'm going to have to step in a mortgage at pushing 7%. But the flip side is I have to buy it from somebody who's going to then extinguish their mortgage that might be sitting at 5%, 4%, and they're going to then trade into whatever they replace their new house with a much higher mortgage rate. And that arbitrage is slowing and suppressing resale supply nationwide.
And what about the single-family rental space? How is capital allocation shaping up in that sector?
Overall, you still have the same geographical constraints from a single-family rental. I think the biggest sort of issue there seems to be the policy, some of the policy discussions, the executive order that came out from President Trump in January of 2026, talking about concern about investors sort of crowding out families who are seeking to buy homes. So that executive order is sort of in motion, if you will, and it'll be interesting to see how that works its way into policy. There's a key exception in there around build to rent. So I think it appears like it's more focused on competition for existing housing inventory rather than new supply creation. I think that's one way to read the build to rent exception. But I think as you look at that market, that policy will shape it. And I think M&A participants are waiting to see how that works its way through before jumping in, if you will.
So that should be fairly calm for the time being in that sector.
Yeah, I think there's some caution to proceed, if you will.
Right. And what are the potential impacts of platform consolidation and expansion among investment managers and service providers in the CRE sector?
I think a fair amount of consolidation, investment managers and service providers. And I think part of that is around trying to get sort of vertical integration. So like going through and consolidating across the platform, the different services that you buy as a real estate participant. So Rhythm Capital did an acquisition of Sculptor, Crestline, and a large real estate acquisition of Paramount Group. And it kind of assembles, they have investment management, they have private credit, they have mortgage servicing, they have direct real estate ownership, which is the bringing in the Paramount assets. And so it's sort of all under one umbrella. It's sort of a one-stop shop, if you will. And that's creating a vertically integrated entity. You would think as consolidation continues, if you're a smaller player across any of those, you might be an M&A candidate going forward. And maybe that's a springboard as they consolidate to different providers or smaller providers along the different verticals to be purchased.
Say there are any lessons from the current cycle that could help investors better position themselves for M&A opportunities down the line?
I think the answer is always to try to be as nimble as possible. So to have capital available and to be able to move quickly when spreads or valuations line up. It's tough to anticipate what's going to happen with interest rates. It's tough to anticipate what's going to happen geopolitically. But if you have access to capital and have your strategy in place, you can be nimble and pounce at the right time to make a deal when the right factors line up. So I think you can sharpen up your thesis, understand how you want to go through it. You can stress test financial scenarios. You could do identifying potential partners early and work on a pipeline to do all your homework in advance. And then the key is to be ready when the market presents the best opportunity.
Jonathan, we've touched on lots of different areas, but any final thoughts or themes that you think listeners should go away with?
The one thing I find interesting, and it's in a smaller community, but the capacity in office, particularly as we talked about in the Class B type offices, is struggling in terms of vacancy and the like. And so you often hear one way out of that is to repurpose it into residential or a mixed use conversion. That's proved to be difficult with inflation, higher building costs, as well as higher interest rates to deploy the capital. One thing that I saw Washington, D.C. do is provide some government support and incentives from an urban perspective to incentivize the conversion of office to these other uses, whether it be mixed use or residential. And to the extent that becomes successful, that might be a template going forward to unlock and transition sort of the oversupply in office to a residential opportunity. Absent that support, a lot of these buildings may remain in limbo, but that could be a path forward.
Excellent, Jonathan. Thank you so much for your time.
Of course. Thank you.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.